Eric Bible with the Bible team at Neo Home Loans. And yes, you read that right. Mortgage rates hit a 3-week low. And the question becomes, have we turned a corner or is this just a head fake? So as it starts the day, the 30-year fix is currently sitting at 6.92%, which is down from last week's 7.10. The question becomes, what is driving that and really what can we expect going forward? And it's really layered in the aspect of a turning point in the economy. A lot of data was released this week. We get data next week, and then ultimately the March Fed meeting later this month, where again, we don't believe the Fed will cut rates, but there are some compelling tones that those cuts are in fact coming and that they're coming hopefully sooner rather than later. So let's understand what drove rates this week and in turn what we can expect going forward. So it really was layered in employment and comments from Jerome Powell. So employment we'll start with. A ton of data was released around the employment sector from ADP, which is private payrolls, continuing claims, job initial claims, and then the all-important Bureau of Labor and Statistics jobs report this morning. So we'll start with ADP. Again, private payroll, not what the Fed is really focused on, but it's a good metrics to understand what's happening economically. As we know, we've been hearing continual increase in the number of large corporations and mom and pop shops laying people off. And their ADP yet again was a miss. We saw numbers come in below forecast, 140,000 when the market was anticipating 150. We fast forward to Thursday, where continued and initial jobless claims, as well as job opening and labor turnovers, the all-important JOLTS report, again showed an increase in job openings, which is indicative of future rising unemployment, which we saw today. Initial claims and continuing claims. People are getting laid off, and it's becoming harder and harder to find replacement work. And then fast forward to this morning, the all-important BLS jobs report, and it was some mixed information. But ultimately, as it stands right now, the market is digesting, and in turn, mortgage-backed securities are performing, which is keeping rates at these levels. There was a miss in non-farm payrolls. Market was expecting 200,000 new jobs created. We saw 275. Yet there were two key attributes within that report, which ultimately maintained the rally extended over the last 3 weeks in mortgage rates, and it was around unemployment. Markets were bracing for unemployment to remain at 3.7, yet it rose to 3.9. Additionally, there were revisions in the January report, which we know January was a blowout number. Those revisions brought that down over 100,000 in jobs. So really, there's becoming more of a compelling argument that, yes, the labor market isn't as robust as once imagined, which in turn, we know the Fed, where, yes, inflation is moderated, which we get inflation print next week, which again, we'll have a recap on. But the labor market, that missing puzzle where unemployment rising, new jobs creating, which is future casting in inflation concerns, we're starting to see cracks in it. So it will be interesting to see how this unfolds in the coming weeks and months. But for now, we're basking in it. Then we rewind actually to Jerome Powell. He testified in front of the House and Senate committees. And the biggest takeaway there was rate cuts are imminent this year, were his comments. They are expected to take place in 2024. Now, again, no timelines, no expectations around frequency, the amount, so on and so forth. But he was adamant to say in front of both the House and Senate that, yes, rate cuts are coming this year. And ultimately, Wall Street and bonds relished in that information. So again, as we know, and as I've said before, and as we've seen over these last 2 years, no one knows certainty except for the Fed. But hearing those comments in stark contrast to comments, this time last year, the year before, the fact that rate cuts are being discussed, ultimately mortgage rates are benefiting from it. And with that, really want to close with what we're seeing. Yes, activity is spurring. Buyers are out in full force. We're continuing to hear multiple offers, property selling higher than list price. It is feeling very different in a good way than what we've seen in really months and ultimately years past. So, with that, what we're also seeing is the integrity of approvals. Unfortunately, this week, our team had to step in and rescue two transactions, both of which were in escrow and told yes by their other lender. The unfortunate aspect there was those lenders could not perform. We quickly identified how to keep the transaction together. Client, referral partners, all were incredibly happy. So, really, the takeaway here today is the integrity of the approval. Who you work with matters. Our process ensures that when that approval letter is issued, it is ironclad. And right now, with how hard it is for you to get your client's offer accepted, it is mission critical that the loan piece is dialed in. If you're running into challenges with this, we would love the opportunity to serve you. As always, make it a great Friday and an even greater weekend. Thank you.